Every time the market's down 20% or so, everybody panics. It's like clockwork, but what if I told you this is precisely when millionaires are created? And I'm going to show you how to invest during a market downturn without losing your mind or your money. So when you look at market psychology, everybody says, well, it's easy to get rich. You just buy low and sell high. But in fact, people do the opposite of that when times get tough. So as optimism, belief, the thrill, and eventually euphoria start to take place, the prices go up, and that's when people start to buy at the very top. And then when complacency, anxiety, denial, panic start to set in, that's when people start to sell, and they start to sell low. And so in fact, you're supposed to buy low and sell high, but people do the exact opposite. And that is why people stay broke. And I think this is due to a few things. I think it's due to lack of education, which is why I bring Budgetdog Academy into every conversation, because this is the best service in the world that we offer internally. I think it comes from a lack of conviction and understanding of the underlying asset that people are buying. And I think this comes from a lack of plan, which is what we help you build within Budgetdog Academy. And if you're looking to take this to the next level, go in the show notes below and book your free call with my team today. And if you see my tweet on the screen, the funny thing about this is the stock market actually does have a 100% recovery rate. But like I say here, every single time people think it's different and people think that the market's going to crash but again, that wraps back up to my first point. They do not have an education. They have a lack of conviction in the underlying asset, and they don't actually have a real plan. So when times get tough, which they inevitably will and always will happen, they start to panic. So I want to walk through my 5-step sanity framework today that's going to help you stay invested during the bad times and actually get rich. And I've been doing this for a long time. And as you can see on the screen, I was right in 2018. I was right in 2020. I was right in 2022. And I said I will be right in 2025. And as you can see and peep the date of April 6, 2025, and you can see the comparison of where the market was at that point in time, everybody was once again panicking. And as I film this today, the market is again at an all-time high. And like I told you, follow the fundamentals. You're going to get rich with me if you do. But this time, I need you to actually listen, because I won't force you to get rich. But what I will say is I have all the data in the world to back what I'm talking about. And that's why I'm so confident in my ability to build wealth. So the first part of the 5-step sanity system is the mental reset I need you to take. Take a 10-year view. So right now, let's just say the market is crazy. The market's very volatile, which is very normal, by the way. But let's just say it is, and you feel uncomfortable. Look at today's price and ask yourself, in 10 years, will the price of that asset that you're buying be more or less? If it's a low-cost index fund or an ETF and it's broad market based, I would bet all my money in the world it's going to be more in 10 years because the data says so, and I'm going to share more data in a second as to why that's the case. But first off, from an emotional standpoint, just take a 10-year outlook and think bigger than just today and in the emotion that you have in your brain today. The second thing is have an opportunity audit. See what's actually on sale and what's just having a pullback. Sometimes there's pullbacks that aren't really on sales. They're just it's just the market adjusting to the real true valuations of where they should be. And sometimes you have a meta sale like I did in 2022 when it dropped 70+% and I bought it at $97 per share. And as of today, it's over $700+ and I've returned 700+% on that investment. It was because I looked at the fundamentals of that specific company and realized that company was undervalued. And again, I was right because of data, not because of my emotional opinion. Number 3 is dollar cost average. This is the anxiety reducer. This is putting the same dollar amount into the market on a periodic schedule. If you do this, you're going to have really good results and you're not going to worry about when the market's down because you're automatically going to buy more when it's down because you have the same dollar amount. So when the price drops, you buy more. When the price goes up, you buy less automatically. And this is why dollar cost averaging is so effective. Number 4 is the quality education. Put the work in now to educate yourself to get the benefits later. We talk about education in Budgetdog Academy a lot. I'm going to share some data that might shock you. So as you can see on the screen, guys, the $20,000 investment somebody made in 1979 and leading that up to 2022 had some pretty drastically different results depending on what you did during that time. So the first thing is that if you did nothing during that time, you just invested $20,000 in 1979 and did nothing, your return would be almost 12% or $2.1 million during that time. However, if you thought you were smart, you could time the market and do different things, or you just became emotional and then tried to do different things. If you just missed 5 days out of 43 years, you would have had $800,000 less result at $1.3 million. And if you missed the 30 best days, you would have only returned $341,000 comparably to the $2.1 million. That's a $1.8 million difference. So if you want to be cute, if you want to be smart, if you want to listen to your latest trader and stock guru online, be my guest. If you want to get rich, you follow me and you join Budgetdog Academy. It's pretty obvious. And if you miss the 60 best days, as you see on the screen, your return would be negligible or $100,000 and only 5x over a 43-year time period. That is abysmal. But that's not all I have for you. If you look on the screen again, I also put another tweet out a while back. In the last 40 years, the best 10 days out of more than 10,000 days accounted for almost 2/3 of the stock market return for the entire period. So if you think you're going to time the perfect timing, you are respectfully a moron. And I hope that hurt the people that try to do this, because sometimes the truth needs to be said and feelings need to be hurt for you to make change. And I know in today's political environment, we can't say that stuff, but I'm going to, and I don't care. Cancel me. And a really fun stat that's going to get you right here is 7 in 10 of the best days in the market over the last 20 years came within 2 weeks of the worst days. So during the bad times is when the best days actually occur. And so if you miss that time, that graph earlier I showed you is what you're going to become. And then let's look at it holistically. The S&P 500 has finished 75% of the time in the green for all calendar years. So most of the time, it's actually a green and positive year. But 25% of the time, 1 in 4 years, is going to be red, but that's expected. Over any 1 year period, you have a 75% chance of gain. Over any 5 year period, you have an 88% chance of gain. And over any 15-year period, you have a 100% chance of gain. If that doesn't speak to you, I don't know what will. But if you don't listen to this data, you're going to be the average investor. And over the last 30 years, and this is an ongoing statistic on a rolling average, the average investor returns 4%. Whereas the average market, if you're just the S&P 500, which is very bare minimum, that's returning at 10% per year. So that's a 6% difference. If you're investing $2,000 per month over a 20-year period and you're getting the difference of those returns, that is $750,000 difference that somebody would get being the average equity investor. And the average equity investor is doing everything I'm telling you not to do right now. So hopefully you're listening, but I don't force people to take action. And step 5 of the 5-step sanity system is building an automated financial roadmap, which is what we do with our students in Budgetdog Academy. These are tailored steps for you individually that's going to give you specifics as to what you're trying to accomplish within your financial situation. Before the month occurs, you know precisely what your goals are, which account to use for those goals, how much money to put in those accounts, and precisely what your investment allocation is. You don't have to guess when you have a plan. Your expenses, your debt pay down, your investments are all automated, and we have conditional logic built into your system that's pre-programmed to trigger different things depending on what's happening in the market. For example, tax loss harvesting, 401k conversions, or maybe moving pre-tax to Roth. All of the decisions are being made based on pre-programming that we've already set up within your system. And you might think based on my age, I haven't lived through a bad time, but I have twice, 2008 and 2020. In fact, in 2020, I was a full-grown adult that was investing very heavily during that time and made a killing. But in 2008, I wasn't an adult, but I did live with a family that lost their house due to the recession of 2008. And that was a really bad time. And I wish I would have been able to experience that as an adult, but I didn't. But I did see what happened in the household. And because we weren't prepared financially, we lost our house, we lost our car, and essentially lost our lives. But since that moment, because I have real world experience, I promised my wife and my kids I would never put them in that position. And that's not to fault my parents. I love them to death. But the reality is what happened was not good. Let's take 3 investors as an example here and show you the reality of what could happen. They have $10,000 in 1980. And as you can see on the screen, investor A invests immediately and never sells. Investor B tries to time the market, but he misses the best 10 days. Investor C misses the 30 best days. What do you think the results are going to be? Investor A ends up with $1.1 million. Investor B that tried to time the market ends with $490,000, losing $700,000 plus dollars. And investor C that missed the 30 best days barely ended up with anything, only $125,000 off the initial $10,000. If you keep going against what I say, you're going to continue to get bad results. If you listen and become smart and wise based on my experience and data, you're going to get really rich. It's really a decision that you get to choose. Common mistakes to avoid during this is panic selling, like we talked about, the lack of education, which you can fix today by going to the show notes and booking a call with my team, and 3, trying to manually run your finances and not building an automated financial system that we build with you in Budgetdog Academy. I don't know what else to tell you. The data's here. It's pretty dang obvious what you shouldn't do and what you should do. And if you can't come to the conclusion of joining the Academy today, I have no faith in you. But I hope you're a smart individual, and I hope you upgrade your life today and invest in yourself, because that is how you're going to build wealth for your family and generations to come. So remember, when the market does drop, you have the ability to change your life. You have the ability to build an immense amount of wealth. But if you keep doing what you've always done, you're going to get the same result. So I hope this sticks with you today, and I hope this genuinely helps you, and I will see you next week.